Free cash flow is an important measure to the market because it represents management team's capital optionality and acts as a cushion when business conditions are challenging. Broadly calculated by adding capital expenditures back to a company's net cash flow from operations, free cash is often used to pay dividends, buy back stock, or for acquisitions. To avoid traps, investors should be wary of high cash flow yielding companies that are scaling back capital expenditures. The reduction in near-term expenditures, investments, inflates free cash flow, but often does so at the expense of plant and equipment improvement and potential future growth. To identify high cash flow yielding companies and compensate for deferred capital expenditure risk, we ran a screen of the S&P 500 that included companies with a 2019 free cash flow yield in excess of the market, 5.2%, but excluded those with an average 3-year annual capital expenditure growth rate below 5%. While those are often the sectors that have heavy capital spending burdens, they also tend to be the sectors with the best margins and cash flow generation. Companies that reinvest in their own businesses and generate increasing amounts of cash flow tend to outperform in any market. But those are particularly attractive attributes in markets where economic growth is plateauing or slowing. As economic growth rates at home and abroad are recalibrated, corporate free cash flow generation will likely rise on investor priority lists.